most of the advisors that we work with would like to have the same investment structure across their entire client base. They don't want to single out the ultra high net worth. They'd like to have that same structure and design so they could say to everybody in their client base, hey, it doesn't matter what size you are, if you come with me, I'm going to get you the same structure and design that I get my very largest clients.
If you're hedging, it doesn't matter if you're in U.S. stocks, overseas stocks, large, small, growth, value. You're hedging. You're doing something active to protect against downside risk. And so it's actually a strategy as opposed to a specific asset class. That's what we mean. So if in fact that's the movement, then it's not about asset allocation anymore. It is about finding different strategies that will work in different times with different types of vehicles.
There's been this myth that there is much more skill in the individual hedge fund area than there is in the hedge funds that are now in the alternative strategy. That may have existed as the initial hedge funds the initial mutual funds came out. That doesn't exist anymore. There is tremendous skill that is being brought over into the alternative mutual fund area. To me, especially in fixed income, it's at a level equivalent with, or to be very honest, superior to what exists in buying individual hedge funds.
I think what we've seen since 2008 is advisors really demanding product that gives low correlation within a broader portfolio. So the notion of delivering diversification has really taken a beating since 2008, and there's been a flight to quality, and when that happens, assets are either deemed risky or non-risky, and therefore correlations go to 1. And so for an advisor to truly deliver diversification, they need investment vehicles that they can place within the context of a broader portfolio that dampens portfolio volatility. We have a number of strategies that do that, and I think for any manager who offers alternative mutual funds, the notion is they can't just sell or present that mutual fund within a vacuum. It needs to be presented within the context of a broader portfolio. We call it building more durable portfolios, and we actually have an investment team that we're building that we're going to work with advisors to really deconstruct their portfolio construction process to determine where might alternative mutual funds make sense within the context of a broader portfolio. And I really think that's the name of the game going forward. It's really delivering on that notion of lower volatility and diversification for a client. That's where alternative mutual funds fit in. It's not just comparing one managed futures fund to another, but what does a managed futures fund do within the context of a portfolio an advisor's already constructed for their client?
If your portfolios are less volatile and your business model is fee only and you're charging a percentage of assets under management, you have a less volatile flow of revenues. So from a business standpoint, you can plan a little bit more effectively because your revenue stream is going to be smoother.
The other big advantage that exists right now with the mutual funds is they are much more liquid than the hedge funds. Now, my primary focus, my primary expertise, if I have an expertise, is over in the fixed income area, fixed income and fixed income alternatives. In the fixed income area, we had a tremendous credit stressing in 2008. With that credit stressing, about 40% of all fixed income hedge funds went illiquid. With the mutual fund structure, where you're able to go beyond illiquid securities, you're able to go to holding liquid securities, to holding ETFs, to holding hedge funds, you can tremendously shrink the portion that is illiquid and therefore avoid that liquidity issue.